Well, it is officially summer. And now that we're heading towards mid June, not only are we starting to see some positive data signs in the residential housing market for the first time in at least 4 years, we're now starting to see some positive signs in the commercial market as well. Well, this is the latest article in The Real Deal, and it talks about Austin's commercial market. And what it's saying is basically, yes, we were the tech darling. We were booming through COVID. And then, of course, people call it a crash or we softened, had a big market correction. But despite the media saying, oh, maybe Austin's kind of done as being a tech darling, quietly, all that stuff we had to build, all these apartment complexes and all these offices, they are filling up because of the population growth. Basically, what it said is it may no longer wear the tech darling crown. Think of it as media articles, but it's still growing fast, remains a hotspot for companies looking to relocate to the Sun Belt. We just topped the 1 million mark as in the city limits. As a population, the city's grown about 4.2% since 2020. And then also between 2018 and 2025, if you think about how many companies move their headquarters to Texas, well, Dallas was number one in the country. 111 companies moved their headquarters to the Dallas DFW area, but Austin was right behind them with 89. So Austin continued to see a lot of companies move here. The big part that Austin had to deal with was the apartment complexes. After rapid population growth sent the prices soaring, developers lined up to meet the need and delivered over 107,000 apartment units in the past 6 years. I want to put that into context and why that has been so critical to why Austin has had to kind of course correct. If you build 107,000 empty apartments, imagine our metros growing about 40,000 people a year. Okay, well, 40,000. Then the next year, you go up to 80,000, 2 years of that growth. Then the third year, you get 120,000 new people. You literally took care of them for 3 years with just new apartments. They didn't have to go buy a house. They didn't have to buy a townhome, a condo, live in an RV park, nothing. You built enough apartments to take care of almost 3 years of population growth. So what's happened is, you just overflooded the market with all this rental supply. Rents had to come down. When rents come down, what happens? People rent because it's cheaper to rent. And so now they're renting and they're living in that nice apartment and getting rent deals. And so people that would normally buy are going, hey, it's kind of expensive to go buy a house right now and the rent's getting cheaper. I'll just rent. So it's really delayed a lot of buyers. And at the same time, the housing prices were too expensive. We had overpriced. So you needed the price to come down. You needed the rents to come down, but now you need the demand to go back up. That's the part that's starting to change. And I'll show that to you here in the data. But finally, you're getting these apartments, all these new apartments finally starting to fill back up. Well, let's look over at the housing side of the market. And we are, let's call it year 4, entering year 5 after May 2022. So May 2022 is when really the interest rates went up, the market kind of stopped and started shifting into where we are now. We've now gone 4 full years, May 2026. Now we're in June. So we're starting year 5. And I think it's taken all that time for that new inventory to hit the market, get absorbed, change all the pricing so that everything is starting to course correct to today. So we're still seeing the price soften, okay, but we're seeing units, sales go up. Okay, so we're seeing sales go up. Home sales increased by 8.4% in Austin in April. That's the second highest gain in the country. So over last year, we're having way more buyers now, 8.4% more buying homes than we did at this time last year. Single family homes is driving a lot of that. Population growth, we've added over, again, almost 20,000 jobs in the last year. That's some of the highest in the country. Listings are starting to drop. That is good as well. So I'm going to show this to you in a couple charts. So that's not the one I want to show you. Home prices. Here we go. This is comparing us to the national average. This is why news articles are so confusing when you're reading about the housing market. You need to read about the Austin housing market because it's not the same as the national. So in Austin, pricing is about $430,000 for a median home in the market. We've dropped about 3%, which is about $15,000. So 15K off last year, home prices have gotten a little cheaper to buy in the area. The US as a whole is still cheaper than Austin, but their home prices went up a little bit, 1.7%. So where are you looking? And I'll show you what markets are seeing big changes. And we're kind of in the middle on the national rank. Here's the price chart. You've seen that before. We've been softening. This one's more interesting. The percent change in sales prices. Hey, anybody want to notice where COVID was? Look at the big orange mountain there. So huge run up in price. And the second the rates went up, huge downturn in price. And now if you look to the far right, you can see that percent is just kind of bobbing along. It's more negative than positive, but generally it's softening a lot less. And so I think what's happened is I call that the stabilization phase. We're starting to lock that in. Change in sales prices. If you added up these four negative orange lines on the right, you're probably a little over 20%. So that's been the price adjustment since peak COVID that we saw. All right, sales prices. This is just how much does it cost to live in a market? Okay, well, obviously, San Francisco, San Jose, LA, California, the most expensive state to live in. We're kind of in the middle at 434, maybe Vegas, Phoenix, Nashville, Salt Lake, Miami. These are more expensive markets, Denver, than Austin. So if you're moving from, let's say, California or one of those markets, Austin feels affordable. However, if you're moving from Charlotte, Orlando, Atlanta, Baltimore, Dallas, Philly, Chicago, Columbus, Kansas City, Houston, San Antonio, if you're moving from any of those markets, Austin feels expensive. It's all perspective. Where are you coming from? We're kind of in the middle. We're a more expensive city that's not on the coasts. That's how I would describe it. Change in sales prices. Again, this is where local news really is going to drive, or local articles are going to drive the story. If you're in Cleveland, they're on fire. They're going up 8.1% over last year on appreciation because they don't have any inventory. Everybody's battling over the same stuff. So all the cities where they're not building a lot of stuff or where they have a lot of land restrictions, stuff like that, San Francisco, Kansas City, Pittsburgh, Chicago, Columbus, Detroit, Midwest, those types of markets are appreciating pretty strong. You come to the bottom, there's Austin at the bottom of this list. So Austin, San Antonio, Miami, San Jose, Minneapolis, we're seeing price adjustments in these markets more than any other. And so again, what market are you looking at there? I thought there was one more chart I wanted to show you. Active listings. Yep, we've peaked out on that. Here's the percent in active listings. This is the last chart I'll show you. So again, you can see where we were in COVID, losing listings, right? We were way under. We couldn't catch up. Housing was getting bought and listings were just dropping to zero. Look, we dropped almost 50% in 2021 in terms of listings in 1 year, by the way. So just all the housing got chewed up. And then the interest rate, and then bam, we spiked up, 120 plus percent in 1 year on inventory. Why? Because those interest rates killed the market. Prices were too high. And again, now you can see it's adjusting back to flat. So what's happening is now we're starting to feel those listings actually peak off and start to be lower than we saw last year. Let's look at that in the data in real time. So this is May data. I shared this with you last week. We're sitting about 5 months of inventory, maybe just under for the metro. That is not bad. That's a fairly okay market. But we are still seeing more price reductions than we're seeing pending listings. So we have more sellers not able to sell, having to make price adjustments, than we have buyers buying those properties. But if we look at supply and demand, the bright orange line is this year. We're just ever so slightly less than last year. We have a little less supply, but we're still well above the 10-year average, but we have a little less supply. However, if you look on the right, demand is noticeably up from last year, and we're now within kind of the 10-year average on demand. So we have buyers. What we still have is a bit too much inventory. And so again, I think it's going to take a year or two to work that back to what a seller would think is a normal market where things sell in a month. That's not typical. A lot of stuff on the market is still taking many months to get under contract because there's simply not enough buyers to the sellers, but it is improving. And we're seeing that here in the data. This is going to be real time. So this is single family homes on the market. And the green line is active. And again, I said this last week, I'm going to say it again. I think last year was the peak of supply. And I think we're going to slowly see it whittling down. If we look right now, June, active listings, single family homes, still have a lot, 14,600 homes in the MLS. But if I look last July, we had 15,800. you had at least 1,700 more homes for sale. That's a lot. It's a lot more homes. We're seeing less this year. And we closed out over 3,100 single family sales in May. If I go back to July last year, we only had 2,700, not even 2,800. So we're selling 300 or 400 more homes a month this year than we did last year. And that's also what's helping decrease that supply. So that is good news. And all this is happening despite rates not really going anywhere. In fact, rates have been going up since February. We had rates, they were kind of trickling down through the winter. We got to 5.99% in February. Boom, then we have the Iran war. And of course, inflation goes up, the bond market goes up, rates have gone up. So now we're sitting around 6.6%. You can get it down maybe to high fives with some buy downs or maybe great credit and like a VA loan or an FHA loan. There are opportunities to get lower rates. But just know, as rates go up, that is pressure on buyers. It's putting pressure on their ability to make the mortgage payment, making it harder to sell homes. So amazingly, despite all that, I think Austin has finally course corrected enough on price that it's allowing buyers to still make the numbers work and buy properties. That's a good sign. If we get a catalyst, let's say a positive catalyst the second half of this year, what would that look like? Maybe the war ends. Maybe oil comes down and gas gets cheaper. Maybe something can happen where the bond market softens a little bit, gets a little more optimistic. Maybe they're not at 4.5 on the 10-year, it drops to 4.25. That will bring rates down some. I do not expect we're going to see any fives anytime soon. In fact, I think it's more likely we're going to hit a 7 before we hit a 5 on the 30-year fixed rate mortgage. But if we can stay in this mid sixes, the market is saying, hey, we can live with that. And housing is moving. So pay attention to that. If you are a seller right now, be aware that we have passed the peak of the year. The peak is generally that May, early June window for closings, which means those were buyers who wrote contracts in February and May. Okay, so now we're entering summer months. Summer months tend to have the highest supply, but they start to slow down on buyer activity. Why? It gets hot, people go on vacation, there's just not as much urgency. So if you're a seller right now, pricing is critical. And really watch showings, because showings are going to tell you how many buyers are out looking for your product. And if you're not getting a lot of showings in the door, you got to be sensitive on price. If you're a buyer right now, you probably have the next couple months where you're going to have a decent supply to look at, and then be aware that supply starts to shrink as we head into the fall. So this is also where you're going to have the peak of opportunity in terms of listings on the market to look at. Anyways, I hope this was helpful. If you want to watch these videos each and every week, make sure to go to our YouTube channel at Ryan Kelly Group. I will have new videos on this topic each and every Monday. And of course, if you know somebody looking to buy, sell, invest, or finance here in the Austin area, would love the opportunity to talk with you. Anyways, again, midsummer, finally starting to hit those mid 90s here. And we'll see how it goes. But it should be a drier, warmer week. And I'll bring you more news next Monday. Thanks.